Hey guys, what's going on? This is Kyle at Projection Hub, and today I'm going to be talking about what financial details should you include in your business plan. The business plan process for any sort of startup can be kind of an overwhelming process. There's a lot of information to write, not sure what to write, and if you're kind of trying to even figure out how or what to write in your business plan in general, we've got a bunch of different free business plan templates you can check out. I've linked those down in the description below. There's a video walking through, it's like 60 or 70 different industries at this point, so you can check that out. But today's video is primarily about when you're going through that business plan and you get down to your financial projections section. If you weren't already overwhelmed, that's a lot of times the section that, founders and, owners and small business owners kind of like their eyes glaze over and they get super overwhelmed and they're not sure what to put on there. And so that is the purpose of today's video. I'm going to show you that financial projections, the financial plan section of a startup business plan. What should you put in there and what should it look like? And what are some things you could include but don't have to include? And, just talking a little bit more about that section. So I should have mentioned, maybe I already did, my name is Kyle. And before my time with Projection Hub, I was an SBA loan officer for almost 7 years. And so in that role, it looked like working with business owners a lot, primarily startups, to review their business plan, review their projections, put together their loan package, take them through that process. So I did that for about 7 years. And then I've been with Projection Hub for about 3 years now. And we've helped more than 50,000 different startups and small businesses create financial projections for their business plans, their loan applications, for their pitch decks, you name it. And so quite a bit of experience looking at business plans, knowing what makes a good business plan, and especially the financial projection side. So yeah, in today's video, we're going to focus on what should you put in the financial projection section of your startup business plan. If at any point you have a question, drop a comment down below the video. You can also email us directly at support@projectionhub.com. We'd be happy to answer some questions for you, take a look at your business plan, your projections, you name it. And if you like this video at any point, give it a thumbs up, consider subscribing to the channel, and let's go ahead and get into it. All right, so here I've got what was a real client business plan that we put together for a startup restaurant. We've changed it quite a bit. So, it's kind of anonymized and it's more of a fictional example now, especially the financial section, which we're about to get into. But just wanted you to see that, this is an entire business plan. That's not the point of today's video, but we do have many different videos about writing business plans. Again, I think I mentioned in the intro, we've got a bunch of free business plan templates. You can check out the link down in the description below. We do offer services to write business plans. We do offer services to create projections for you. I'm not going to bore you with those details today. We'll link those down below as well if you're interested in. But today's video is just about trying to be helpful and educate a little bit about what should you include in your financial projection section of your business plan. If you've gotten to this point in your business plan or you're preparing to write your business plan, this can feel like a daunting task. So hopefully can shine a little bit of light on that. So we're just going to go through the financial section of this business plan, and I'm going to talk about some of the details in here. And I've written in some things that could show like what you could add in if it is suitable for your situation, but you wouldn't necessarily need to. So yeah, let's just go ahead and look at it here. Now, one thing I'll mention is, this business plan in total is, it's on the longer side to what I would say. I like business plans in the 15 to 25 page length, and your projections will probably end up being like a third of that, if not more than that. So it's okay for it to be a big section. You don't need a ton of words. You don't have to have a ton of words in your financial projection sections. If you've got visuals, if you've got financial statements, if you've got things like that, you can kind of let the numbers talk for themselves. If things require some narrative to help explain it, feel free to include that. But you don't want the whole thing to just be text and narrative. The visualization of the numbers does help when it comes to processing that, conceptualizing it, and just making things look organized. So let's just kind of go through this here. So there's an overview, which isn't all that important. It's just kind of like, now we're going to talk about the numbers. But first off, rightfully so, we're going to talk about the startup cost breakdown. And maybe one quick plug that's worth mentioning, up at the top of your business plan, in your executive summary, you could also have one little paragraph about financial details. That's one little tidbit that you may not want to wait for the first time for them to set eyes on any financial details, is all the way down to financial projections. You might make a little summarized paragraph and put that up in your executive summary. But first up, we've got our startup cost breakdown. Let me see if I can zoom in without screwing anything up, so you can see things a little bit better. And in this case, I'm just using a pie chart and a little startup cost table that we've got outlined here, so we can see, we're going to need $350,000 for our startup costs, and generally how those are categorized, right? And this pie chart and this table are telling the same story, so it's nothing too fancy. You could just do your startup costs in a bullet point list. That's totally fine. I'll show you where some of these numbers come from in a little bit. So these charts and stuff will make a little bit more sense because they're just being generated automatically. So it's easy for me to include them. But of course, you want to have your startup costs. Like if you're asking for financing, that's probably the purpose of your business plan. Business plan writing is just a good exercise, but nobody really writes a business plan if they're not trying to get funding from someone or they're being told they need a business plan, if we're being honest. And so, yeah, you need to break down like how much is it actually going to cost for you to start your business. Now, in my example here, I'm using a restaurant. It's obviously going to look different for your industry, where you're located. The number might be smaller, the number might be a whole lot bigger, right? So it's just going to be kind of on you to understand what's going to make sense there. And we'll talk about benchmarking here in a little bit and some exercises you can do that are helpful for that. So now that we've talked about how much it's going to cost, and something worth mentioning here, and again, I'll show you the tool that helped me generate some of these things, but you'll see this little thing right here where it says months covered 1. Well, there's actually some text cut off right there, so you can't really see this, but something to keep in mind is you're going to have your outright costs, your startup costs. So like your equipment, all of these things listed, assets, different things like that. But you also need to think about, you're going to have to cover your losses until the business is profitable, until it's not just sucking cash out of the business and it's actually it's paying for itself and putting some of that back in. And so that's another thing to keep in mind. You might think, okay, it's going to cost me $200,000 to buy all the things I need to get open. But it's another thing to say like, well, if it takes you a year to be profitable, or 6 months to be profitable, or 18 months, you got to cover those losses until then. Your expenses, you're going to have overhead expenses. You're going to have loan payments. You're going to have lots of different things that should be calculated into your startup costs, right? It's going to be your working capital, or, basically you need to account for that. Okay. So that's one thing to keep in mind. And then your funding required. So of those startup costs, we've said we have $350,000. Where are you going to get that money from? And I guess where are you going to get it from? So let's see how we're breaking this down in our example. So especially if you're applying for an SBA loan, Small Business Administration loan, there's going to be a minimum owner investment requirement. So that's I think it's in the 10 to 20% range. So maybe, definitely make sure you double check that. Could be updated in the last year or two. But usually in the 10% is going to be a safe thing. So, you're going to have to put in that amount, just like if you're buying a house and you have a down payment, you need to invest that. Your lender is not going to give you 100% of the loan proceeds, most likely, unless it's some sort of special loan program. So mention what your owner investment is going to be. In this example, we don't have any investors involved. So if you have an outside investor, or a silent investor, a family or friend member, an equity investor, is that equity investor using a convertible note? Like, make sure you talk about the type of investment, that's coming in. And then obviously whatever isn't being put in by you or maybe an outside investor, you're probably going to be getting that in a loan. So in this one, it's pretty simple. Owner's putting in 50 grand and they're asking for a $300,000 SBA loan. Now, if you really want to get kind of fancy, you can change your business plan per lender and say, who you want to borrow it from. You don't have to do that, but we do want to include that in there. And then we've got a little just estimated revenue overview. Here's a nice little table that gives like a quick snapshot of our 5 years of projections. So we've got revenue, cost of goods sold, and then like profitability. We've also got some nice industry specific data, like per year, how many customers do we hope to serve, and a breakdown of how much per customer like they're going to spend. You can see we're including that going up, takeout orders. So like that type of information right there is probably not standard, right? That's not going to be in your typical business plan. And I'm just going to show it to you now. Like, this is not meant to be a commercial for this. We are talking about what's included in the business plan, but all of these things, I generated those using a projection template. So we've got, I think over 120 different industries maybe on the website, where we've got these projection templates where you can fill out the projections and it'll generate them for you. So, we put in information on these blue tabs. So we're putting in things like, what assets do we need to purchase? When do our projections start? Are we going to need any loans? And again, we're only editing the blue cells here. So like I'm looking at the restaurant one because that's what my business plan is. And I've got my menu here. We're calculating, how many seats do we have in the restaurant, turnover for that. We've got evening time, takeout and delivery. We've got some sections hidden. Like I know this template includes a breakfast and a lunch section as well, but I'm not using those right now, so I have them hidden. Then we've got our direct costs. So like our, hourly employees there. We've got our overhead costs. So this is what we're paying for every month. The first few months are broken out. So if there's some more expensive things in the launch months, we can incorporate those. And then we've got our kind of salaries here. And then it's generating all of these charts, which you've seen in my projection template, in my business plan. And then before I jump ahead, let's go back. Okay. So just to be clear, that's where this data is coming from. You don't have to use the tool like that in order to incorporate these types of information I'm telling you about. I think these are just, all these things I'm talking about are really going to make this section as strong as it can be. And if you'd like to use a tool that's going to help you do the projections side of things, you can check out our templates. Again, those are linked down in the description below. I think there's even a link down there maybe to get a promo code. Don't hold me to that, but I think that is the case. And so, yeah, we've got some key ratios here, which are really just our growth metrics. A little chart showing our sales growth, profitability growth. A list of our operating expenses or monthly overhead. And then we've got, some people call them pro forma statements or financial projections or projected income statement, or projected profit and loss statement, all the same thing. But you can see here, I've got I can move my face again, sorry. 5 years of an income statement or profit and loss projected, right? So we can see by year, our first 5 years, some line items for how we expect to perform. And then we got the same thing for cash flow statement and the same thing for a balance sheet. So hopping back over to my projection template, you can see those are generated in here, right? So anything I change in these blue tabs automatically changes these financial statements. And the financial statements are meant to be exactly what a business owner needs for like their lender. That's the whole point. So we've got a monthly breakdown and an annual breakdown of all three of the financial statements. And again, out to 5 years. You may only need 3 years for your lender. We like to use 5 just to be safe. So just to go back up to hit this again, we're having a projected income statement, cash flow statement, and balance sheet. Okay, so startup, we should include those things in our business plan. You should have some you should mention break-even point analysis. Now, there are some like scientific, technical explanations of break-even point. So I think officially it's like when your cumulative income or revenue surpasses cumulative expenses and costs, right? So like if that day is on your 27th month is when you finally have earned more than you've spent in your business, that's your break-even point, right? Like that's like the official definition. Coming from, when I was a lender, that's not really what we cared to know. It was more like, when are you, like how quickly you're going to get to the point where you're generating more than you spend on like a monthly basis. And then like, is that to a sustainable and growing point? If it's just like a blip on the radar, then it's like, that's not really helpful, right? We want to know, when do you expect to consistently keep bringing in enough to cover everything, right? That includes your loan payment. One thing I thought about including in your business plan, but I thought it's not really worth getting into, and that's calculating your debt service coverage ratio. That's a number your lender is going to be calculating. That's really just a calculation of, for all the things that you're planning to having to pay for, will you be generating enough cash to also pay for your loan payment, right? So they kind of have a minimum number, right? It's usually in the 1.15 to 1.35 range. That if you're in that number ratio, that should mean you should be able to afford the loan payment. But when it comes to break even, what I've got included in here is you can just see a little chart which shows this, you follow that line. We're losing money when that line is kind of coming down, and then you can see we're kind of coming back up there. Another thing I included in here, I know it's kind of small, and that is a snapshot from our cash flow statement. And so if you just see this line right here where it says net cash from operating activities, so that means things we're doing to bring money in. These parentheses right there mean that we're losing money, and you can see like, wow, we had $58 more come in than went out, and that number starts to steadily climb. And then if I looked at my year 4 and year 5, it would just keep going up and up and up, right? You can look at a similar thing on your income statement. Those are the kind of things that matter to me more as a lender, right? So we can see here on our income statement, we can see our losses or our net income at the bottom, right? So we're losing money on to year 2, losing money, but it's getting smaller. Year 3, smaller. You can see our first profitable month is month 32, which is probably a little later than you would want or expect, but just as an example's sake, and you can see it starts to climb up regularly. Now you can see we're not losing money anymore. Okay, so that to me as when I was a lender, that's something I cared more about than like the official break-even point when you've cumulatively have made more money than you've spent on your business. So that's what break-even point to me matters. So like, when are you going to start actually being profitable? This section here I left in just so you're aware of it, but I don't actually think I would write this in my business plan, and that's understanding the assumptions for your projections. Assumptions mean how did you actually come to these numbers? So using something like a template is helpful for assumptions because you can just show them the template. So this tab says assumptions, right? We have things like loan and how much we're planning to spend and some different things like that. But you also have assumptions like, when you just say, we're going to estimate this much revenue, and they say, well, how do you know that? I can say, well, we're estimating 45-minute table turnovers, this is lunch right here, right? Average visit length is 45 minutes. We're serving lunch 2 hours a day. This is the capacity we're estimating at. This is how much we think that's going to grow year over year. Here's what our menu offering is going to be and how much each person is going to spend. So filling out this template is the assumptions, right? So all of the information going into these blue tabs and is spitting out these things, those were our assumptions. So sometimes as a lender, when you give them the financial statement, which is what they want, they might also ask you like, well, how did you come up with those numbers? And those would be the assumptions. So my inclusion of this is not to say you don't have to write in all of your assumptions. Sometimes people put them in the appendices or whatnot, but just be prepared to know and explain where those numbers came from, and using something like a template is helpful. Okay, and I've got 3 bonus points. One general bonus point, and this is just a recommendation, is make sure that your projections are realistic and within industry norms. That's just some advice to give to you. And maybe you're wondering like, well, how am I supposed to know? So I'm going to use this set of projections as an example to just demonstrate for you, right? So I like to come to this tab, this summary tab, and it's an underwhelming answer, but just go Google it, right? Just go out and look like, what is a typical profit margin for a startup restaurant? What is a typical profit margin for an auto repair shop? And you can do that with any number, any line item. And you can do that for estimated revenue in a place, cost of goods sold. Just look that up for yours, or you can use a tool like ChatGPT and you can ask for it to give you a whole bunch of numbers at once, right? So I can see gross profit margin, but then net profit margin. Typical is 5 to 10% net profit margin for a restaurant. Okay, so then I go back to my projections and I see what my profit margin is. -8%, -4, 0, 2, 5. So mine's conservative, right? I'm assuming it's going to be a little bit worse than what the industry average is, which I would rather be conservative than saying I'm going to have a 25% profit margin, because then your lender's going to be like, whoa, they are clearly missing something. So make sure you do that exercise. Fill out your projections and create your projections to the best of your ability, what you think makes sense. But then go back and benchmark that. Do some Googling, use a tool like ChatGPT just to find out what our typical ranges and numbers for your industry, and then compare that to your projections to make sure that your projections aren't like totally in left field, because that would be a red flag to a lender. And then 2 final bonus points of things that if you apply to your situation, can really be great in your financial section of your business plan, and I would encourage you to include that. One is this traction slash pre-launch revenue. So depending upon your industry, your type of business that you might be starting, this might be applicable or not. But what I mean by that is, like, if your type of business is something that you can or have been doing on the side or in a smaller scale before like an official grand opening or a grand launch, include whatever information you can about that. So in my fictitious example here, I said before official launch, we participated in 3 local food festivals to generate some excitement and introduce people to the menu and whatnot. We brought in $15,000 and we had over 500 people sign up saying they were eager to try our new restaurant and receive a 10% discount within the first month for a grand opening. You don't really see that in a ton of general business plans, but I promise you, this does wonders, right? It's gonna be good for the obvious reasons, but it also demonstrates some intangibles to your lender, like you're really dedicated, you're gonna hustle, you've got grit. So it's just a really great thing if you can do that. And you don't have to just naturally have done that. You can make it a point to be like, well, when I launch my business, I'm gonna dedicate 6 months to doing this on the side to try and generate some traction, is what's called, or some momentum, some proof that if you can give your lender confidence that when you open your doors, people will be there, they'll know who you are, they'll be coming to use your restaurant or whatever your business is. That is huge for your lender versus just not knowing if people will show up. Bonus point number 2, if it applies to you, is outside income from the owner, right? So a lot of people think when starting a small business, what they think their lender wants to hear is that they're going to quit their full-time job and focus 100% on the business. In some cases, in many cases, that is, unavoidable, right? Like you got to go all in, or maybe you're the sole employee for your own business, and so you can't manage a job and the business on the side, or maybe it's a really good opportunity or whatever. That's totally understandable. But if your situation is one where you could justify continuing to work, so meaning like you could have a manager run the day-to-day, or the business is something that you can do on the side, or maybe you can work part-time and have the business an extra hour. So if I get it, that's very stressful. It can be exhausting for some amount of time, but it helps alleviate pressure on the performance of the business right out of the gate, and gives the lenders a little bit of leeway on some of the calculations they're doing. So for example here, and when I was a lender, we saw this all the time. There were many cases where we even asked if the person would be willing to keep their full-time job, and that would give us the comfort to move forward with the loan. And that worked out many different times. And so you can see an example of that, right? The owner maintained their full-time day job, earning $100,000 after tax annually, and only 50% of that was used towards their living expenses, their family expenses. And that left an additional $50,000 annually that could supplement the business's cash flow until the business can easily replace that income. The outside income will be primarily used for, yada, yada. So that's an obviously like a great, that may not apply in a lot of cases, but that is a really great bonus. And if that applies to you potentially, I would encourage you to include it in your business plan. And so there you have it. That's the financial projection section of your business plan. A lot of information in here. Again, a lot of this was generated using a projection template. I put a link down in the description below that will take you to our library of projection templates. Actually, I think I have it open here. So you can see all the different ones here. You can search for your industry. And down in the description below, I put a link to a promo code as well that you can grab. But the point of today's video was just to talk about what should you include in your business plan. If you have any questions about your business plan or about your projections, please reach out at support@projectionhub.com. You can also comment down below this video. We'll see you there, and we can help you out there too. But give the video a thumbs up if it was helpful to you. That helps us as a fellow small business. And we'll see you on the next video. Good luck. Thanks.